Welcome to Alpha Insights. I'm Hope. Today we're talking algorithmic trading for retail investors, how to move from manual rules to automated strategies. With me is Ryan, an investment advisor who helps DIY traders build systems. Remember, if you have questions as we go, you can ask us at stockalpha.ai. Quick note, markets are closed today. It's Sunday, June 28th. So any market references are heading into the long weekend based on where things stood as of Friday, June 26th. Ryan, great to have you.
Thanks, Hope. Great to be here. Excited to walk through the practical side of algorithmic trading. Not just the idea, but the steps people actually need to take.
Let's start simply. What is algorithmic trading in everyday terms?
At its core, it's rules encoded in software that create orders and manage positions without you clicking each trade. Think of it as turning a repeatable decision process, entry signals, position sizing, stops, and order placement into a program. The payoff is discipline, speed, and the ability to test many ideas quickly.
So it's not magic. It's more like a disciplined checklist that runs automatically.
Exactly. And you want to build the system in 3 layers: signal generation, portfolio and risk management, and execution. Treat each layer as separately testable and auditable.
Walk me through those layers in plain language.
Signal generation is the brain. Indicators, simple stats or models that say buy or sell. For a beginner, that could be a moving average crossover or a momentum ranking. Portfolio and risk management decides how big each trade is, how correlated positions are, and where stops sit. For example, scaling position size to target a certain volatility rather than a fixed dollar amount. Execution is the hands, converting desired positions into actual orders while thinking about market impact and fills.
Got it. People often hear about backtesting. How do you make those tests realistic?
The biggest mistakes are using the wrong data and assuming perfect fills. Use adjusted price series for return calculations, but use raw trade or tick data if you're modeling execution. Correct for corporate actions and avoid survivorship bias by including historical delisted symbols when testing index strategies. Simulate commissions, borrow costs, and slippage. And crucially, never peek at future data. That look-ahead bias will make your results lie to you.
So, walk-forward validation is important?
Yes. Optimize on one period, validate on the next, then roll that forward. It shows whether parameters generalize across market regimes. Also do Monte Carlo resampling or randomized trade orders as a sanity check. If random shuffles produce similar returns, your strategy may be overfit.
Practical question. What tools and brokers do people actually use?
Retail-friendly options include brokers with application programming interfaces, or APIs, like Alpaca for commission-free U.S. equities, and interactive brokers for broader global access and advanced order types. Evaluate API latency, streaming data, margin rules, and fees before building production systems. For data, vendors range from free services for prototyping to paid tick vendors for serious intraday work.
You mentioned live trading earlier. How do you move from a paper backtest to real money safely?
Start with paper trading in the broker's simulated environment. Then run shadow mode, live market data but no real orders, to compare expected fills to real-world fills. When you go live, deploy with a fraction of your intended capital. Measure slippage and rejection rates, then scale slowly. And build kill switches, automatic halts on single trade losses or unexpected API failures.
Can you give a couple of concrete strategy blueprints that are realistic for retail?
Sure. 1. An intraday mean reversion on Apple using 5-minute bars. Signal is a z-score versus a rolling 60-period mean. Enter when the z-score is above 2. Place limit orders at mid or slightly better, cancel after 30 seconds, and size to target about 0.5% intraday volatility per position. 2. An end-of-day factor rotation among 3 ETFs, the S&P 500 ETF, the NASDAQ 100 ETF, and the Russell 2000 ETF. Use weekly momentum to allocate to the top performer and rebalance weekly to keep turnover low. 3. A pairs trade with Ford and General Motors using a co-integration residual, size to dollar neutrality, and account for borrow costs.
That helps make it concrete. Now, common pitfalls?
Look-ahead bias and survivorship bias are top technical traps. Also, ignoring transaction costs and slippage makes a strategy look better on paper than in reality. Excessive parameter tuning is a route to overfitting. And operationally, weak production controls, no kill switches, unsecured API keys, or missing monitoring cause real losses.
Quick reactions.
Mm-hmm.
Interesting.
Right.
On governance and monitoring, what should listeners have in place?
Automated monitors for position limits, latency, and API error rates, fill ratios and slippage, plus daily P&L versus model drift. Set automated kill switches for specified drawdowns or technical failures, and keep a runbook for on-call responses. Human oversight remains essential even with automation.
A couple of listener FAQs. How much capital do you need, and can you use machine learning?
Capital needs depend on the strategy. Intraday, high turnover strategies often bump into pattern day trading rules and margin requirements. Brokers may require at least $25,000 for those accounts. End-of-day or swing strategies can start smaller, but should account for commissions and diversification. Machine learning is usable, but treat it as a tool. It needs large, clean data sets, careful feature engineering, and robust cross-validation to avoid spurious signals.
Final quick takeaways for our listeners.
1. Separate your system into signal, risk, and execution, and test each independently. 2. Use realistic data and fills in backtests, and validate with walk-forward tests. 3. Move to live trading slowly. Paper trade, shadow mode, small allocations, and strong monitoring with kill switches.
Love that. Thanks, Ryan. And listeners, if you have questions about anything we discussed today, you can ask us directly at stockalpha.ai. We answer listener questions live. And for more market insights and guides, head over to stockalpha.ai. That's Alpha Insights. I'm Hope. Talk to you next time.